South Africa's biggest insurance companies are expecting to wave a wave of cash-strapped South Africans to withdraw up to 25,000 Rand each from their pension savings when the new TwoPot retirement system comes into effect next year. This comes as the South African government finalizes proposed legislation that sets new rules for the TwoPot retirement system. Now, the system will allow members of retirement funds to access 1/3 of their pension savings once a year in the event of an emergency, while preserving the other 2/3 for retirement as a better alternative to people who are resigning their jobs to access their pension funds. Now, the reform is also meant to deter South Africans from cashing out their retirement savings when they resign. So this morning, joining me on the show is Stephen Walker. He's the chair of the Retirement Matter Committee of the Actuarial Society of South Africa. Thank you so much, Stephen, for joining us.
Thank you very much.
So for those who really do not understand what the TwoPot system is and how it works, I'd like you to just give us a bit of education on that.
Sure. So the TwoPot approach should be seen as the latest step in a history of social security and retirement reform that we're trying to bring through in South Africa. So the concern is that we have a pension system in South Africa, but it's not necessarily fit for purpose for everybody. So for the last 10, 11 years, we've been progressively introducing more and more reforms. So our government is trying to say, there's a system, but how can we improve it? How can we make it better? So TwoPots is the latest announcement of what's going to be introduced from the 1st of March 2024. And even before COVID, we already had this idea of these pension funds that came here, that were brought here to this continent. They're not really fit for purpose. They're not really helping the people of this continent. So people in our country, how can we make them more relevant? And this is the solution that we've come up with to say that in future, so from the 1st of March 2024, your contributions, your benefits will be split, as was described, 1/3, 2/3. So 2/3 of the money will go into what we call a retirement pot, and it's subject to compulsory pension preservation. In South Africa, we've never had compulsory pension preservation in occupational retirement funds. So most countries across the world have got different types of occupational retirement funds that have got compulsory pension preservation rules. We don't, so we're an exception. The government, even going back decades, has been trying to introduce compulsory pension preservation. And people like us, the actuaries, we think it's a good idea because then it forces people to actually save the money for retirement. But people are saying, we need the money now. We're struggling now. And so the other 1/3 in future will be going into a flexible savings pot, and that money can be withdrawn on an annual basis. So subject to the minimum, as you said, of 2,000 Rand, which is about $110 or something like that. If you've got enough of the money built up in your savings pot, then on an annual basis, you can take that money out. There would be costs involved, there would be taxation involved. So we are discouraging people from withdrawing such amounts, but it would be open to people to take that in future.
But financial experts are actually concerned that many people might want to cash out with the 25,000 Rand option. So are you sure that is a good idea, looking at the fact that the saving culture in South Africa is not really healthy?
Yeah, no, excellent question. So the 25,000 Rand is the rule with respect to vested benefits. It's the money and the benefits that have built up until the 1st of March 2024. So initially, when we were at the height of COVID, and this was being negotiated, the idea was that access would be allowed to the vested benefits. Then the government said, well, we're coming out of COVID and it's no longer necessary. But there was a massive outcry led by organized labor who said people are still suffering. People must be given this access. They must be allowed access, which is based on 10% of your vested benefits as at the 1st of March 2024, subject to the 25,000 Rand figure that you're quoting. So we in the industry, we are going to be actively discouraging people from doing this. We want people to see the so-called savings pot as an emergency savings pot. You must only be taking that money out if you are desperately, desperately in need of it. It shouldn't just be seen as a short-term savings vehicle. A retirement fund is for long-term savings. But you're right that individual actuaries and other people in industry have come out with concerns to say that over the short term, this is likely to be detrimental for people's savings. Over the long term, when we look back in 10 years' time, 20 years, 30 years' time, we're expecting these changes to have made a significant difference to benefit outcomes. And in the meantime, in the short term, we're trying to educate people, we're trying to communicate with people to say, be very, very careful, please, before you go and take out these once-off withdrawals and pay the tax. The taxman will be very happy with you taking the money, but in 5 years' time, you're going to regret it.
So now that we see that this system is aimed at actually helping South Africans in financial distress, does it cut across the public and the private sector? And what implication would that have on pension funds and the insurance system?
So the idea is very much to cut across both. So it's private sector and the public sector. Some of the details are still being sorted out. So ourselves as the actuaries, we're getting involved on both sides, private sector and public sector, to make sure that there's consistency. When you look at public sector, which is largely defined benefits, and private sector, which is largely defined contributions, that same philosophy, that philosophical approach must come through. So since I work for an insurance company, speaking from an insurance company's perspective, there is an expectation of a massive amount of withdrawals. So that hundreds of thousands of individuals wanting to take withdrawals. So they're trying to find ways to automate this, to make it more streamlined and use technology to make it more efficient. Because come the 1st of March next year, there's going to be this expectation of a massive amount of people wanting to take withdrawals. No matter how much we try to discourage people, the reality is that we're expecting quite a lot of people to want these amounts. And so, like I say, there's going to be a huge knock in March. One would expect that things will get better with that compulsory preservation coming through.
All right. Earlier on, you talked about the fact that some savings or some monies will go into the retirement pot and another will go into the savings pot. So I'd like to ask, for the savings pot, is it incentivized? And will that also help improve the financial security for these individuals who will be making do with this particular system?
So by incentivized, if you mean, does the government match contributions or
yes, in that regards, and also in a way encourage the workers, as it were, who will be making do with this platform, have some sort of financial rewards to make them always want to save? Or is it going to be automatic?
No.
Is the process going to be overly automatic?
So the process will be overly automatic. In South Africa, unlike most countries, even in Africa, there's no compulsory requirement for people to save for retirement. That's a further step that we're going to be looking forward to in the near future in South Africa. So currently and historically, it's up to the employer to decide whether individuals, their employees, must belong to a retirement fund or not. And going forward from the 1st of March 2024, all retirement funds will have this. It will be automatic, this 1/3, 2/3 split. On the public sector funds, it's a bit more complicated because they don't really work on a 1/3, 2/3 allocation when it comes to the withdrawals that can be allowed at retirement, which is what has been accelerated. But that same philosophy, like I say, will be coming through. But there's no incentivization where the government matches or increases contributions. In South Africa, we very much work on a cost to company basis. So there's a total remuneration of X, and the retirement savings are going to come out, and then those retirement savings are going to be split 1/3, 2/3. At a future stage, what we're looking at is the informal sector, where for the informal sector, government is looking at incentives. How do we get people in the informal sector to also save for retirement, but not for formal sector workers? And the TwoPot is very much about formal sector workers.
All right. Now, you've also said that the process will be modified and perfections will be made as the days go by. So I'd like to find out, for people who will be willing to access their funds, maybe on or before retirement, are there certain requirements or things they would need to consider to do that? And will the process be seamless, stress-free and fraud-proof? Or people should be wary about some certain loopholes when it comes to putting their funds in and accessing their funds as at the time they'll be needing it?
Yeah, no. So I think, we are still in the stages of figuring out. So what we've got is draft legislation, and ourselves as the actuarial profession and ourselves as industry, we are providing feedback to government to make sure that things are going to be as streamlined as possible. But there's always going to be some hiccups. So, this world that we live in is not perfect. So one should expect that there's going to be hiccups along the way. People should not be seeing this as a short-term savings vehicle. So if someone has that flexibility to save either in the occupational retirement fund or outside of the fund where they want to access the money in the short term, we would tell them don't put it in the occupational retirement fund. This is tax incentivized. There is a tax deduction, so that's the incentivization, but it's because it's here for the long term. And when you withdraw that money, you're going to be losing out some of it on tax. If you're saving for a short-term payment, rather do it out. So if you're saving towards buying a house in 6 months' time or in 18 months' time, or buying a car, rather do it outside of your retirement fund. This is for emergency savings. That's what we're trying to emphasize. But obviously, it's difficult for some people. They find themselves in circumstances. And as you mentioned earlier, we don't have a proper savings mindset in this country or even in this part of the world. So people tend to live from month to month, and they get themselves into desperate situations. They have huge amounts of debt. The debt collectors are knocking down the door. The children need to go to school and they can't pay the school fees. Therefore, they start to get desperate and they start looking to access retirement savings. But at least this will stop people from resigning and becoming unemployed, because we've got a total unemployment rate in excess of 40% in this country. So what we've seen in the past is people will deliberately resign just to access the retirement savings, but then they find themselves worse off 6 months later when the retirement savings are all spent. So that's why we're trying to introduce a more flexible system that's going to give better results over the long term. But in the short term, there's going to be some stumbling blocks. There's going to be some speed bumps. So we do tell people as individuals, please think about this carefully. Please seek independent, reliable financial advice if needs be. Please don't rush into taking any decisions that you're going to regret in the long term.
All right, thank you so much, Stephen. We see that education is key, and you have done a bit of that this morning. Thank you so much.